Hello and welcome to our continuing coverage here from Davos 2023. I'm Shireen Bhan. It's a very cold morning, but it stopped snowing, so that's the only good part as far as the weather is concerned. You know, India is making its presence felt here in Davos like never before. If you walk down the promenade, which is essentially the high street for Davos at the time of the World Economic Forum, you will see several lounges that India has set up. There is, of course, the India lounge set up by the central government. There are state lounges from Maharashtra to Telangana, and there are, of course, a plethora of Indian companies, the tech companies, that have their lounges as well. So there's India quite prominently on display there on the promenade. Well, what you won't see is either the Delhi government or the Punjab government's lounges, but what you will see is India's youngest Rajya Sabha MP, Raghav Chadha, who also happens to be a young global leader here at the World Economic Forum. He joins us now. Raghav, good to have you back here in Davos. It's a pleasure to speak with you. As I was saying, India prominently on display here in Davos this year.
Absolutely, and I think that is the diversity dividend of India, where you have several states participating, having multiple chalets. I think we're the only country that has so many chalets on the promenade, and a healthy competition among states competing in a healthy way for investment, seeking investment for their respective states, and with the overall objective of strengthening India. So I think India is making its presence felt at Davos 2023 at the 53rd annual general meeting of the Davos. Yes, and Delhi and Punjab, as you mentioned, they may not have a chalet yet.
They have you.
Well, I am in the capacity of a young global leader as a YGL, participating in the 53rd AGM. And on the sidelines, I'm also trying to catch up with several industrialists from across the globe and essentially see if they're interested, you know, for investment purposes back home in Delhi and Punjab, and a conversation around what we can offer, what sort of red carpet can we roll for them if they were to invest in our states.
You know, you talked about this healthy competition, this competitive federalism in India, and you also talked about rolling out the red carpet for both domestic as well as global investors. What is going to be the pitch that the governments, both of Delhi and Punjab, are going to make to investors at this point in time to draw in fresh investment, particularly Punjab?
Well, speaking of Punjab, which is the food bowl of India, which is the land of green revolution, which has the most enterprising set of individuals in the country, is a state that has several things to offer when it comes to investments. From a very strong logistical backbone, where Punjab has been rated as the safest logistical, you know, sort of chain that Punjab has as far as the Indian ratings are concerned, with ICDs, with multimodal logistics parks, etc. Apart from that, we are giving statutory backing to ease of doing business with legislations, with the Punjab Anti-Red Tape Act, with the Punjab Right to Business Act, one-of-a-kind act in the country. And apart from that, Punjab has the highest internet density in the country, low cost of power. Government is incentivizing investment like never before, whether it's access to subsidized land, whether it's giving the YGF, the VGF, that is the viability gap funding, relaxation in the fixed capital investments, GST incentives, waiver of stamp duty, so on and so forth. And it's a liberal market with no stringent labor laws. So I think all in all, Punjab is a package that a lot of investors would certainly be open to considering. And it's not that there hasn't been investment in Punjab previously. I remember even in the dark days of 80s, when Punjab was unfortunately going through the worst period ever of insurgency, militancy, and so on and so forth. In the year 1989, you would be surprised to know, PepsiCo started its first potato chips company in Sangrur, which is its biggest plant. In fact, they're up their investment further in the decades to follow. And not just that, Punjab has the world's biggest tractor manufacturing company in Hoshiarpur. We have the biggest cycle manufacturers in Ludhiana. So I think there is an environment of investment that we're here to project. And above all, I think a government that means business, a government that has zero tolerance towards corruption, is what is required. Hand-holding by a government that does not have vested interest in business, that doesn't want kickbacks from the industry. That's the kind of governments that people and industry are looking forward to working with closely, and I think that's what Punjab has to offer.
Hey guys, welcome back to Business Lunch. For the market, we pretty much erased all of the gains and then lost a bunch also since the top of the trading session. We got that gap up start, but we're at the low point of the day. It is only tech which is holding up well and the PSU banks, but barring that, even all of the financials which were doing really well in the morning have come under severe pressure. But we'll talk more about the market action in a bit. First up, let's drill it down to some individual stocks. Sula Vineyards is surging in trade after reporting a strong third quarter business update. Mangalam is here with the details. Mangalam?
Sula Vineyards reported a strong third quarter update. So 13% jump in their overall revenues year on year. And this is the highest that the company has reported on a quarterly basis. It's also the first time they've reported numbers ever since they've listed. So a 13% jump in their own brand consumption, which is the mainstay of the company. The other part of the business, which is also tourism, wine tourism, has seen a 13% growth. From the start of this year to now, there's been a 28% jump in their own brands revenue and 48% jump in wine tourism as well. And that, of course, comes on a low base. Going forward, wine tourism business doing well could be a bigger trigger for them because this is a high margin product. And another important trigger for them is their new capacity coming on stream. 2.5 million litre cellar, which has come on stream right in time for the 2023 grape harvest season, which the company's release suggests that is likely to be strong. So, if the harvest season is good, with them having increased capacity could do well for them, and that would mean that there could be further support for volumes going ahead as well. So good update, good outlook, and the stock up 11%.
Good update, good outlook, and the stock is surging like Mangalam said. But Mangalam, stay with us. We also had Avenue Supermarts, which is in focus post their Q3 numbers, and this one is not looking good. The stock also taking a beating. But take us through the earnings fine print.
Well, it has been a weak quarter for them, no two ways about it. For DMart, the stock is lower primarily because, the EBITDA as well as the net profit was a sharp miss as against street expectations. The stock is at the low point of trade. The gross margins actually were at a 7-quarter low for the company. They've said that, the non-FMCG discretionary products for the company this time around, which are usually higher margins, haven't done well for them. And even if you look at the revenue per square feet, that metric hasn't come back to pre-COVID levels, even as all other matrices have come back to pre-COVID levels itself. So on the revenue front, the company met expectations, but those analyst expectations were also built around the company's third quarter update. The EBITDA and the net profit have been lower than street expectations, and as a result of which we've seen a slew of brokerage downgrades as well. Edelweiss, Nuvama, has actually said that they've cut their target multiple on the stock from 60 times to 55 times EV to EBITDA. We've seen a downgrade come by from Morgan Stanley as well, a downgrade to equal weight with the target price being cut. And UBS, who were always sellers in the stock, have also cut their target price further to around 3,500 odd rupees. The only thing to watch out for in DMart now is the fact that they've ramped up their e-commerce experience. Its operations have been expanded to 4 new cities, and they've also launched a new subsidiary to sell pharmacy products in store itself. So that could be another stream for augmenting revenues. But at 73, 74 times, it's always traded at a premium to the entire sector, and as a result of which some of the halo is waning off.
Oh, definitely. This is not a cheap stock. And Mangalam, thanks a lot for breaking down all of those earnings for us. But HDFC Bank is in focus. That is a big one that we got over the weekend. It was a strong set of third quarter numbers, and the bank also posted its best ever return on assets, and the net interest income has jumped to a 7-quarter high. So in their con call, the bank's chief financial officer, Srinivasan Vaidyanathan, also spoke on issues from the RBI note for the merger as well as the outlook on the loan front. So let's listen in to some of those comments as well.
Not heard yet, but we would expect it within the next month to. There's no particular time frame, right? This is not a particular schedule. For context, is that the merger process is progressing. The NCLT final hearing is on 27th January, right? And so thereupon, once it's adjudicated, then there are certain other processes, regulatory processes to go through. So we do have some time that this would take, and we are hoping that in the interim period there will be something. We see good demand for loans, right? More than over 30,000-40,000 crores of loans we did not go through. We didn't want to go because the price has to catch up with what we are seeing on the bond market, and it didn't catch up, so we let go, right? And we do see good demand in the NBFC segment, in the PSU, or in the retail and infra segment. We do see good amount of demand coming, and we are also getting on to the new product lines that I mentioned too. Again, driven through PLI or other aspects, we are also into those. I certainly don't want to take a guess, but that is, that has been something that over a longer period of time has remained more or less within a small range, right? So that's not something that generally has happened. But again, the way is that we don't lead with it, but we'll follow the leader on that front. But still, that we price slightly above the largest bank player in the country on the savings.
All right, that is the management of HDFC Bank on how they see, the rest of the year panning out, especially on the loan growth front as well. But with that, let's talk about the IT space now. Most of the big, IT companies have posted their Q3 numbers so far. So Reema is standing by at the big wall to take us through a complete report card on how it has looked for Q3. Reema.
Thanks so much for that. So the biggest takeaway from the big four in the IT pack is that things are steady for now. Despite the macro uncertainty, fear of higher furloughs, execution has been good and the revenue growth has been steady. In fact, 3 out of the large 4 IT companies, namely TCS, Infosys and HCL Tech, have reported a revenue beat. The only one who missed the estimates was Wipro. Now, talking about the Q3 numbers, it's HCL Tech which tops the charts in terms of a quarter-on-quarter constant currency revenue growth with a 5% growth. But all the 4 IT companies have reported a double-digit year-on-year revenue growth. The margin performance was a mixed bag. Infi and TCS margins were lower than anticipated. They were hit by a return to normalcy costs like travel, etc. But on the flip side, HCL Tech and Wipro margins surprised, and look at the way they've expanded. Significant expansion seen on a quarter-on-quarter basis. Here, the INR depreciation, improvement in utilization aided by fresher hiring boosted the margin performance. Now let's move on to the deal wins. Despite some slowdown in decision making, largely the deal wins this quarter have been steady, not as bad as what the street was fearing. In fact, Infosys' large deal wins were at an 8-quarter high. TCS told us their qualified deal pipeline is higher. Wipro told us that the overall deal wins in Q3 were at record levels. So across the board, IT companies have told us that the deal pipeline currently is strong. It's more biased now towards cost optimization deals, and Indian large caps are benefiting from vendor consolidation. So all in all, FY23 is going to go down. It's a good year for the Indian IT companies. Infosys is likely to end with a 16 to 16.5% revenue growth, higher than what they had projected at the beginning of the year. In fact, every quarter this year, Infosys had gone ahead and upgraded its guidance. Even for HCL Tech, despite the hiccup that we had in the month of December, its overall revenue growth is going to be between 13.5% to 14%. TCS doesn't give you an annual guidance, but the street anticipates about a 13 to 14% growth. That said, there is still no visibility from the large companies about FY24. Tech budgets have not been finalized. The commentary, and this is the synopsis, that the European business is a bit challenging. They are seeing slower decision making. As of now, there is no deal cancellation. Wipro has alluded to a slower ramp up in large deals, and there are furloughs in pockets like BFSI High Tech. On the supply side, attrition has moderated across the board, and these are the numbers on a quarter-on-quarter basis, and hiring has been muted. TCS and Wipro have reported a decline in their employee headcount on a quarter-on-quarter basis. One reason for this is the attrition has been coming down, so they need fewer people to fill the people who've left their workforce. But the other reason which the street fears is that the companies are preparing for a slowdown. Now, whether or not that plays out, we'll see. But for now, Q3 FY23 has been steady for the IT companies and not as bad as what the companies and the street was fearing. Back to you.
Reema, thanks a lot for taking us through that complete report card. This is more than enough to have the street relief for now. And I mean, something like a Tech Mahindra is up almost 3% at a time when the market is absolutely flat. But that's what's going on with, the earnings in the IT space. Let's move on and talk about some macro data that came through. India's December wholesale price index has come in at a 22-month low of 4.9%, pulled down by cheaper veggies, fuel, edible oils, and manufacturing products like metals, steels. But the key question now is, does this sort of bring down the chances of another hike from the RBI in February? So Lata is here with a take on how she sees this. Lata?
Well, it's a fairly steep fall in December. 4.9% compares to street expectations of a 5.57. That was the CNBC-TV18 poll. So good 65, 70 basis points lower than what market was estimating. And for your information, the November CPI was 5.85. So it's a 100 basis point fall in December itself. So therefore, this triggers a feeling that with CPI in December also coming below expectations, the stage is probably set for the Reserve Bank softening. Now, main contributors were actually veggies, though I have, edible oils and textiles and steels, all of them were down month on month and year ago. Vegetables have a big weight in the WPI and they've fallen very sharply. So it's a 22% fall month on month and about a 35% fall year on year. So that's the biggest contributor. There's minor contribution coming from fuel. Petrol and diesel are also lower. Remember, the taxes, excise duties don't get counted when you do WPI. So that's why that also is contributing to a lower WPI. The only worries, like I told you, metals have also come down on a month-on-month basis. But the worry really is cereals and milk. That has jumped up both month-on-month as well as year-on-year. But since the headline is what factors in, the economists are now veering around to the view that you can't ignore the possibility of the Reserve Bank pausing in February itself. Even those who believe there will be a hike say that this will be the last and the Reserve Bank will give a very clear indication that we are in a fine spot. You don't see it yet reflecting in the bond yields because the bond yields are worrying about the fiscal deficit and the market borrowing that the budget may unleash.
All right, Lata, thanks a lot for taking us through all of the numbers as well as a complete analysis on what this could mean on how the RBI might act in February. But with that, we are going to get into a short break here. As we do that, here's some important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. You can subscribe to Money Control Pro to get the entire list.
Yes.